Normally, when you look at a company sitting on a fortress of nearly $800 million in cash, with zero debt, you absolutely do not expect them to publicly bet their entire corporate asset portfolio against online flat earthers.
No, you really don't.
And you also don't expect them to brew a promotional beer where the active ingredient is actual, literal bear feces.
I mean, it sounds like the marketing department just completely lost a bet. Or, maybe lost their minds.
Right.
When you see a balance sheet that conservative, you sort of expect the corporate behavior to mirror it. You expect them to be slow, steady, totally predictable.
Exactly. But today, we're taking a deep dive into the Q4 2025 earnings call for Columbia Sportswear Company. Ticker symbol is ULM. And we're going to show you why those completely unhinged marketing stunts aren't just like a desperate cry for attention.
No, they're not at all.
They are actually a calculated, brilliant, and honestly somewhat terrifying shield against a massive geopolitical threat that is currently coming straight for their profit margins. So welcome back to another deep dive. Today, we're taking you right into the eye of a very strange corporate storm.
It really is a storm. And our source material today gives us just the perfect vantage point. We're unpacking the detailed earnings call transcript featuring Columbia's chairman and CEO, Tim Boyle, along with their executive vice president and CFO, Jim Swanson.
Right.
And what makes this transcript so compelling for you as a listener, whether you're an investor holding the stock or someone working in retail, or honestly, just someone wondering why winter coats are getting so ridiculously expensive.
Because they really are.
They are. What makes it compelling is that it is a masterclass in contradiction. You have this fundamentally sound, incredibly cash-rich legacy brand, but they are battling incredibly chaotic, uncontrollable external forces.
And chief among those forces, right, are erratic global weather patterns and severe multi-million-dollar international trade tariffs.
Yeah, those are the twin monsters under the bed here.
So let's start by looking at the foundation they are actually standing on. Because to understand the crazy bear scat marketing, you have to understand the math first.
You always have to start with the numbers.
On paper, Columbia looks like an absolute fortress. But as we dig into these numbers, it feels a bit like a fortress built on shifting sands. Let's run through the headline numbers so you have the context.
Go for it.
For the full year 2025, net sales hit $3.4 billion.
Okay.
Which is a very modest 1% increase. But if you look specifically at Q4, sales actually dipped 2% year over year, down to $1.1 billion. And I mean, for an outerwear brand, Q4 is everything.
Oh, absolutely. It's their Super Bowl.
Right.
And a 2% dip in your most critical quarter, that would send a lot of retail executive teams into a complete panic.
Yeah, heads would roll.
But despite that Q4 drop, their balance sheet is, well, it's what Wall Street analysts literally dream about. They exited the year with $791 million in cash and equivalents.
That is just wild.
Let me just repeat that for emphasis, because in modern retail, it's staggering. Almost $800 million in pure cash liquidity and zero debt.
None.
In a retail landscape where, legacy brands are constantly choking on leveraged buyouts or crazy high interest loans, Columbia is just sitting on a mountain of liquid capital.
Yeah.
They even returned $267 million to shareholders last year through a mix of stock repurchases and dividends.
Which basically means they have the capital to survive almost anything.
They do.
But here is where the narrative starts to fracture a bit. When you look at where that $3.4 billion is actually being generated, it is a tale of two completely different planets. The geographic divergence is just wild.
It really is.
Yeah.
If we pull back and look at the macro picture, multinational retail health right now is entirely a story of regional divergence.
Right, because the whole idea of a synchronized global economy is, well, practically dead at this point.
Exactly. What works in Shanghai or Berlin just isn't necessarily working in Chicago or Seattle. For Columbia, their international markets are absolutely booming.
Yeah, break that down for us.
So China was up low double digits. Yeah. That is incredible given the broader real estate and economic anxieties happening in the Chinese domestic market right now.
Right. Everybody is worried about China's economy, but Colombia is still growing there.
Exactly. Latin America and the Asia Pacific region, they were up 10%. And the EMEA region, which is Europe, the Middle East, and Africa, was up 3%.
Okay, but then you look at their own backyard, the U.S. wholesale business. The executives on the call basically had to admit to analysts that it plummeted by the high teens percentage in Q4.
Yeah, that's a rough phrase to say on an earnings call.
Dropping 15 to 19% in your primary domestic market during the holiday season, that is a cliff dive.
Yeah.
How does a brand grow in China but collapse at home in the exact same 3-month window?
Well, the U.S. decline is a really complex knot to untangle, and I think it highlights just how fragile the traditional wholesale retail model is right now.
Yeah.
It essentially comes down to a trio of specific factors. The first is a pure accounting quirk. It's regarding shipment timing.
Okay, so just logistics.
Pretty much. Some of their massive fall orders, the heavy winter gear destined for department stores and sporting goods chains, shipped a little earlier than originally modeled.
I see.
Because those shipments left the warehouse in September, that revenue was recognized in Q3. So it artificially deflates Q4 on paper, even if the annual total remains the exact same.
Okay, so the first reason is just calendar math. That's fine. But the second reason is much more concerning for the actual health of the brand, right?
Exactly. The second factor is a structurally lower order book from U.S. retailers.
Yeah.
We really have to look at the psychology of the wholesale buyer here.
Right.
The people who are purchasing inventory for major outdoor retailers are feeling incredibly cautious about the American consumer. They're looking at inflation, they're looking at rising credit card debt levels, and they're terrified of committing to massive inventory buys up front.
So they just bought less stuff.
Right. They simply ordered fewer jackets and boots.
Because the absolute worst case scenario for a store like Dick's Sporting Goods or REI is getting stuck with thousands of unsold heavy winter coats in April.
Yeah, you can't just store them in the back room for 8 months. They take up way too much physical space.
Right, so you have to put them on clearance.
And that completely destroys your profit margin.
So that is the exact fear driving the lower order book. But the third reason for the U.S. revenue drop is perhaps the most intriguing one, because it was totally self-inflicted.
It was.
It was an intentional inventory supply constraint by Columbia themselves. They purposefully curtailed some of their fall 2025 inventory purchases from their overseas factories.
Yeah, when U.S. tariff announcements started making geopolitical headlines earlier in the year, management took a highly precautionary stance.
They actively chose to underproduce.
Exactly. They decided to leave potential money on the table rather than risk importing millions of dollars of goods that might suddenly be slapped with exorbitant import duties.
I really have to push back on this strategy, though, or at least look at it from a slightly more critical angle.
Okay, let's hear it.
Think about this fortress balance sheet. Nearly $800 million in cash, zero debt. To me, it kind of feels like one of Columbia's own heavily insulated sub-zero winter parkas.
Huh. That's a good way to look at it.
Yes, it is absolutely fantastic for survival. You will not freeze to death in an economic winter, but man, does it restrict your movement.
It's heavy.
Right. If your primary U.S. market is shrinking by the high teens and you have $800 million just sitting in a low-yield bank account, isn't Columbia playing it entirely too safe?
I mean, you could definitely argue that.
Shouldn't they be aggressively acquiring smaller, hotter brands or aggressively expanding their own direct-to-consumer retail footprint? Like, why act like you're bracing for an apocalypse when you have the cash to go on the offensive?
Well, it's a fundamental debate about capital allocation, and it's happening in every major boardroom right now. You really have to consider the operational PTSD of a management team that has navigated multiple global supply chain crises, a pandemic, and volatile economic cycles.
Sure, they've been through a lot.
For Columbia's executives, that cash buffer is what guarantees their independence. It allows them to actually sleep at night when an external variable like a sudden mild winter or a punitive trade war threatens their core revenue streams.
It's a safety net.
But your analogy of the restricted parka is spot on. A flawless balance sheet doesn't generate cultural heat. You cannot spreadsheet your way into a teenager's closet.
Right. No, you definitely cannot.
Finance will say she doesn't make a brand cool.
Which brings us right to the paradox. The executives know the safe, insulated parka isn't enough to fix the U.S. market. They know they can't just rely on cash reserves to drive demand.
Right.
They need to get incredibly loud to break through the saturation. And that realization seems to be the exact catalyst for their new marketing engine.
The contrast in tone during the earnings call is truly jarring. You transition from hearing CFO Jim Swanson calmly detailing shipment timing and liquidity ratios to CEO Tim Boyle actively discussing the promotional benefits of literal animal feces.
It's amazing.
They launched a new overarching marketing platform called Accelerate Growth, and the consumer-facing tagline is engineered for whatever.
And for you listening, I promise you, this is where a very traditional family-run apparel company completely takes the brakes off. Under this engineered for whatever umbrella, One of your biggest initial pushes was the Amaze Puff collection.
Yeah, the Amaze Puff.
They heavily targeted Gen Z consumers with this, and the transcript notes this campaign was incredibly successful at bringing in a wave of first-time young buyers to their direct-to-consumer e-commerce channels.
Which is great. That is standard, well-executed digital marketing. You make a boxier, brightly colored jacket, you put it on TikTok, you get younger buyers. Good job, Columbia.
Right, but they didn't stop there. They decided to execute a campaign called Expedition Impossible.
This is where we cross from traditional marketing into aggressive earned media stunts.
Oh, yeah. They took out an open letter in the New York Times and plastered it across all their digital and social channels, challenging anyone who fundamentally believes the Earth is flat to find the literal edge of the world.
Just incredible.
And if a flat earther could photograph the edge and prove it, Columbia promised to give them, and I'm quoting the transcript directly here, everything owned by the company, LLC, including gear, office equipment, and assorted used corporate assets.
I love that.
They literally put the entire $3.4 billion company on the line in a bet against online conspiracy theorists.
The calculated nature of this risk is fascinating, though. Legally and scientifically, they are dealing in absolutes. The Earth isn't flat.
Right, so the risk is zero.
The risk of losing the corporate assets, it's absolute zero. But the return on that zero risk bet, massive engagement.
Yeah.
By playfully interacting with these bizarre online subcultures and sparking these ridiculous, highly shareable conversations, they managed to break through the digital algorithmic noise.
Because normal ads are boring.
Exactly. A standard Instagram ad saying, buy our warm coats because they feature thermal reflection, gets scrolled past in milliseconds. But a massive corporation challenging flat earthers to a duel for the company's microwave and fleece inventory, that gets shared.
But wait, because it gets weirder. Let's talk about the tailgate stunt.
Oh, the tailgate stunt.
For the massive professional football championship game in Santa Clara, you know the one, we can't legally say the trademark name, but the big game in February.
Right, the big one.
They ran a localized promotion called Nature Calls. The premise was to highlight how Columbia's engineering makes the absolute worst, most grueling, most disgusting parts of Mother Nature manageable.
Or, as CEO Tim Boyle phrased it on the call, palatable.
Palatable, yeah. To prove this, they brewed a custom beer and served it at a massive tailgate party. And the foundational active ingredient in this beer, bear scat, bear feces.
I can't imagine drinking that.
I know. And just to round out their incredibly eclectic approach to cultural relevance, on the exact same earnings call, they proudly announced they are the official uniform sponsor for the USA curling national team for the upcoming 2026 Winter Olympics.
Curling.
Curling. The sport with the heavy sliding stones and the frantic sweeping with brooms. Look, I actually love curling. It's hypnotic to watch, but you have to admit it's a very specific, quirky vibe for a mainstream apparel sponsor.
It is very niche.
But let's ground this back in reality. You are the one who looks at the spreadsheets. Stunts are fun. Stunts get headlines. But stunts are expensive.
Extremely expensive.
The production of the New York Times ad, the legal team required to clear a bet for the company's assets, the brewing of a biohazard beer. What is the actual financial impact of turning your legacy marketing department into a viral prank channel?
Well, it is definitely leaving a highly visible mark on their profitability metrics. The transcript shows that their SG&A, which is selling, general, and administrative expenses, essentially the overhead cost of running the business.
Right, the lights and the salaries.
Exactly. That increased by 3% for the year. And management explicitly stated that this increase was driven heavily by this new demand creation strategy.
Okay.
In fact, their marketing spend hit 6.5% of total sales in 2025. That is a significant jump from the 5.9% they were spending historically.
Okay, let's contextualize that math for a second for the listeners. If their total sales are $3.4 billion, 6.5% of that is what? Around $220 million just spent on marketing?
Yep, around there, exactly.
Yeah.
When you are operating at billions of dollars in revenue, a 60 basis point jump in your marketing allocation isn't a rounding error.
No, not at all.
That represents tens of millions of newly allocated dollars flying out the door to fund these campaigns.
So they are throwing a massive amount of capital at this.
They are, but the executive team argues it is highly disciplined spending. They aren't just throwing cash into the digital void to see what sticks. Jim Swanson noted they are seeing measurable, data-backed increases in key performance indicators.
Okay, like what?
Specifically what they call unedited brand awareness and branded search volume.
Hold on. For those of us who don't work in a Madison Avenue advertising firm, what exactly does unedited brand awareness mean?
Yeah, fair question. It's essentially the metric of unprompted consumer recall. If I stop you on the street and ask, name 3 outdoor apparel brands, and you instantly say Columbia, North Face, Patagonia, without me giving you a multiple choice list or showing you a logo,
Oh, okay.
that is unedited awareness.
Yeah.
It is the holy grail of brand equity because it means you occupy permanent real estate in the consumer's subconscious.
Got it.
Furthermore, management noted a measurable tracked increase in consumer perceptions of the brand's irreverence and style.
Irreverence.
Yeah, they are actively polling focus groups and tracking social sentiment to measure exactly how much cooler and more rebellious the general public thinks they are compared to last year.
I hear the metrics, but I still have a fundamental problem with this approach, and I want to see if you think this holds up.
Okay, lay it on me.
I look at this and I have to ask, is brewing feces-infused beer a stroke of earned media genius, or is it just a cheap, empty gimmick? Think about it like a struggling legacy restaurant. You see this dynamic on TikTok constantly. A local diner is losing foot traffic, so the owner creates a massive, visually ridiculous stunt menu item.
Like a 10-pound burger.
Right, or they make a hamburger covered in edible 24-karat gold, served on a sword and lit on fire at the table.
I've seen those videos.
And it goes incredibly viral. People line up around the block for 3 weeks just to take a selfie with the flaming sword burger. But does that make them a loyal, recurring customer?
Probably not.
Does a Gen Z kid who watches a flat earther get dunked on by Columbia's Twitter account suddenly decide to drop $200 on an Amaze Puff jacket? Or are they just there for the laugh and then they swipe to the next video?
That tension is exactly what the Wall Street analysts on the call were trying to probe. Because you're right, top-of-funnel engagement does not automatically equal bottom-of-funnel conversion.
A like is not a sale.
A like is definitely not a sale. However, let's push that restaurant analogy further. In today's hyper-fragmented, algorithm-driven media environment, a legacy restaurant cannot convert a customer who doesn't even know they exist.
Right.
The diner is invisible. You have to earn the right to their attention first, usually by doing something disruptive.
Okay.
The viral flaming burger gets you in the door. The actual quality of the French fries is what makes you come back.
That makes sense.
Columbia's argument is that the viral stunt gets the Gen Z consumer onto their website, but the actual technical quality and styling of the Amaze Puff jacket is what closes the $200 sale.
But why pivot so drastically right now? Columbia has existed for decades without needing to resort to this level of shock marketing. Why is this sudden surge of irreverence so urgently necessary in 2025?
Because they are building a shield. Management knows that a massive, completely unavoidable geopolitical cost is coming directly for their profit margins. The tariffs. They're going to be forced to charge the consumers significantly more money for the exact same jacket. And you cannot successfully execute a massive price hike if your brand is perceived as boring, stale, or interchangeable. You need incredible brand heat and pricing power to justify what they're about to do to their price tags.
Wait, so the Bear Scat beer isn't just a marketing team gone rogue. It is a calculated financial defense mechanism against international trade tariffs.
Exactly.
They are being incredibly loud over here, so you don't flinch when you see the price tag over there.
Precisely. The marketing isn't the core story. The marketing is the armor they're putting on to survive the real story.
Which brings us to the elephant in the boardroom, the tariff tempest. We are talking about the $100 million question, and just to be explicitly clear for you listening, we are going to look at this strictly from a business, mathematical, and supply chain perspective.
Yep.
The politics of global trade and protectionism are incredibly complex, but on a corporate earnings call, a tariff is stripped of its politics. It is just one thing. A massive, unavoidable tax on the supply chain.
Exactly. For a CFO like Jim Swanson, a tariff isn't a political debate. It is a brutal math problem. And the math he laid out on this call is staggering.
Break it down for us.
Let's look at the data he shared regarding unmitigated tariffs.
Yeah.
Unmitigated, meaning the raw initial cost of the import duties before Columbia's executive team took any defensive actions to soften the blow.
Okay.
In 2025 alone, these tariffs cost the company over $30 million. That translates to a 300 basis point hit to their gross margins.
Let's translate that financial jargon for a second, because basis points gets thrown around a lot. A basis point is just 1/100 of 1%, right?
Correct.
So a 300 basis point hit means they're losing a full 3% of their total profit margin just to pay these taxes at the border.
Yes, exactly. If their profit margin on a jacket was supposed to be 50%, it instantly drops to 47%.
Yeah.
And in wholesale retail, a 3% margin degradation is an absolute bloodbath.
Wow.
But it gets worse, because these tariffs are stacking year over year. Swanson noted that over a 2-year period, they're looking at a compounding 400 basis point hit.
So a full 4% margin loss.
Right. When an analyst on the call ran the forward-looking math, projecting this unmitigated impact into fiscal year 2026, they estimated the total cost to Columbia could be in the neighborhood of $100 million.
$100 million in pure profit just evaporating from the balance sheet.
Evaporating.
That is an existential threat for a publicly traded apparel company. So how do they fight back? You can't just absorb a $100 million blow and expect Wall Street to smile and nod. What is the actual on-the-ground mitigation playbook for a company of this size?
Well, they are pulling every operational lever available to a multinational supply chain, and it is a massive logistical undertaking. The first lever is vendor negotiations. Columbia is going to their strategic factory partners overseas, the massive textile groups that actually cut and sew the garments, and demanding cost sharing.
So they're squeezing them.
They're essentially saying, we provide you with a massive volume of predictable business. If you want to keep our contracts, you have to absorb some of this tariff cost by lowering your wholesale price to us.
They are using their massive scale to bully the factories into taking a pay cut. But factory margins are already razor thin. How much can they really squeeze them?
Not enough to cover $100 million, which is exactly why they have to pull the second lever, resourcing production.
Moving the factories.
Yes. They are actively tearing up their supply chain maps. They are moving manufacturing out of the specific countries hit by these high tariffs and relocating production to countries with more favorable untaxed trade agreements with the United States.
Okay, but let's look at the mechanics of that, because shifting a massive global supply chain isn't like, changing a grocery store.
Oh, definitely not.
You can't just pack up a factory in one country on a Tuesday and have it running flawlessly in a different hemisphere by Thursday. We are talking about highly technical gear here.
Extremely technical.
Columbia has proprietary fabrics like their omni-heat reflective lining, the little silver dots that bounce your body heat back to you. You have to find a new factory, audit them for labor standards, install the specialized machinery, train a completely new workforce on how to tape seams so they are actually waterproof, and then establish entirely new shipping lanes to get the product across the ocean.
Yeah.
That has to take years.
You've hit on the exact logistical nightmare keeping apparel executives awake at night right now. Resourcing is a multi-year strategy. It's not a quick fix. There's a massive lag time between deciding to leave a country and actually receiving quality-controlled jackets from a new one.
Right.
And because vendor squeezing and factory relocation takes so much time, Columbia is being forced to rely heavily on the third, fastest, and most dangerous lever they have, aggressive price increases.
The ultimate tax passed to the consumer.
Exactly. Yeah. Management explicitly stated on the call that they are enacting high single-digit price increases for U.S. consumers in both the upcoming spring 2026 and fall 2026 seasons.
Wow.
They are mathematically aiming to offset the entire dollar impact of the higher tariffs by simply forcing you, the customer, to pay more at the cash register.
So we are talking about an 8% or 9% price hike across the board on everything with the Columbia logo. But because of the way retail seasons work, there is a dangerous timing catch here. Really.
There is. And this timing mismatch is why their Q1 2026 profit is going to take a disproportionate beating. Right now, as we sit in the first quarter of 2026, Columbia is currently selling through their winter 2025 inventory.
Okay.
Those specific jackets and boots were imported, processed, and financially priced well before this new drastic round of price hikes could be implemented at the retail level.
So they imported the goods and paid the new massive tariff taxes at the port, but they can't charge the consumer the new higher prices yet because the price tags and the retail contracts were already locked in 6 months ago.
Exactly. They are absorbing the full brunt of the higher costs without the benefit of the higher revenue. It creates a severe temporary squeeze on their gross margin until the new spring 2026 inventory arrives with the newly inflated price tags.
Let's zero in on this high single-digit price increase for the upcoming seasons because this feels incredibly risky.
Oh, it's a huge gamble.
If you hike prices by 8% or 9% to offset a trade policy, doesn't that fundamentally alter the demographics of who can afford to buy your brand?
It absolutely does.
Think about Columbia's historical brand positioning. Columbia has almost always been known as the accessible, reliable, family-friendly outdoor brand.
Right, the everyday brand.
You buy a Columbia jacket for your kids to go sledding in the backyard or for a weekend camping trip. You aren't buying it to summit Mount Everest. It is not a hyper-premium elite luxury label like Arc'teryx, where the consumer base is so wealthy they simply don't care if a specialized Alpine shell goes from $700 to $760. Can the average middle-class American consumer actually absorb an almost 10% price hike on family winter gear when housing and groceries are already squeezing their budgets?
That exact scenario is the primary anxiety shared by every retail partner Columbia works with. It's the core tension of this entire earnings call. During the Q&A segment, Wall Street analysts specifically noted a troubling data point regarding Columbia's future order book.
What was it?
They pointed out that while the overall projected dollar value of the future orders is up, because the prices are higher, the actual number of units ordered by retailers is slightly down.
So retailers are hedging their bets. They are buying fewer individual jackets because they are terrified the consumer will reject the new price.
Yes, retailers are terrified of price elasticity.
Let's define the mechanics of price elasticity for the listener really quick, because it's the invisible force driving all of this.
Right. So price elasticity of demand is a fundamental economic concept that measures exactly how sensitive consumer demand is to a change in price.
Okay.
If a product is highly inelastic, like gasoline or life-saving medicine, you can raise the price significantly and people still have to buy roughly the same amount because they have no choice.
Right. You still have to drive to work.
But if a product is highly elastic, like a mid-tier fleece pullover or a branded raincoat, raising the price is dangerous. At a certain threshold, the consumer simply decides they don't need it, or they walk across the mall and buy a cheaper store brand alternative.
Yeah.
Wholesale retailers are ordering fewer units because this upcoming season is going to be a massive real-time stress test of Columbia's price elasticity.
Which circles us perfectly back to the beginning. This is exactly why they are brewing Bearscat beer and challenging flat earthers.
There it is.
They have to make the brand feel so culturally undeniable, so cool, and so irreverent that when you, the consumer, walk into the store and see that price tag jump by 9%, you don't flinch. You say, yes, this is more expensive, but I need the Amaze Puff jacket because Columbia is the brand dominating my social feed right now.
You've connected the dots perfectly. The viral marketing spend isn't just about driving young people to the website. It is the psychological armor they are building to justify the tariff-induced price hikes. They have to artificially elevate the perceived value and cultural cachet of the brand to match the new, legally mandated higher price of the physical product.
So with prices rising aggressively and the main Columbia brand getting heavily squeezed in this high-pressure environment, it makes me wonder about the rest of the family.
The portfolio brands.
Right, because Columbia isn't just one brand. They are a corporate umbrella that owns a portfolio of different companies. How are the smaller siblings surviving this exact same economic pressure?
It's a critical question.
Yeah.
Columbia refers to these smaller siblings as their emerging brands. And what makes them uniquely vulnerable is that they derive almost all of their revenue exclusively from the U.S. marketplace, making them hyper-exposed to the exact domestic retail slowdown and tariff issues we just analyzed.
Right. They don't have China to bail them out.
Exactly. And their performance in Q4 was incredibly mixed.
Mixed is a very polite corporate way to say it. Let's look at Sorel, their specialized footwear brand known for those heavy winter boots.
Yeah, Sorel had a tough quarter.
Sorel took a massive 18% hit in the quarter. Now, management was quick to clarify that this was mostly brand to the wholesale shipment timing issue we discussed earlier. The boots shipped in Q3 instead of Q4. But seeing a negative 18% next to a brand name is still a brutal visual for investors.
It definitely hurts the eyes on a spreadsheet.
Then you have Prana, their yoga, climbing, and activewear brand. They saw some slight direct-to-consumer growth, but overall, they were down 5% as they attempted difficult pivot, trying to shift their wholesale targeting toward more specialized lifestyle fitness accounts.
But amid those localized struggles, you have a standout star that completely defied the gravity of the U.S. retail market, Mountain Hardware.
Yeah.
While the rest of the domestic portfolio was stumbling, Mountain Hardware posted a massive 44% increase in sales.
44%. In a quarter where the main Columbia brand was struggling domestically and the overall U.S. wholesale market was down in the high teens. How does a legacy outdoor brand suddenly achieve 44% growth in a shrinking, cautious environment?
It is a textbook turnaround story, and it provides a roadmap for how you actually grow a brand in a tough economy. The massive jump wasn't an accident. It was driven by 3 highly disciplined strategic shifts.
Let's hear them.
First, they executed a drastic reduction in clearance activity. In previous years, Mountain Hardware had gotten addicted to dumping excess inventory at heavy discounts just to clear out warehousing.
That is an easy trap to fall into.
Oh, totally. While that generates quick cash, it degrades the brand's premium reputation and destroys gross margins. This year, they held the line and sold primarily at full retail price.
It's the classic luxury strategy. You protect the brand equity at all costs, even if it means selling fewer items, because selling at a discount trains the consumer to never pay full price.
Exactly. Second, they implemented what the marketing industry calls strong full-funnel advertising.
Let's break down the mechanics of the funnel for people not in digital marketing. They aren't just like buying a billboard for brand awareness.
Right. A full-funnel approach means you are guiding the consumer through every stage of the psychological journey. The top of the funnel is broad awareness, maybe a visually stunning video of a climber on a mountain that introduces the brand.
Okay.
The middle of the funnel is consideration retargeting that same user a week later with a specific ad explaining the technical waterproof specs of a jacket. The bottom of the funnel is conversion hitting them a few days later with a seamless one-click link to buy that exact jacket in their size. Mountain Hardware mastered this sequence this quarter.
And the third factor?
The third factor was a highly successful, targeted product launch. The high-tech Mythogen Snow Kit. But it wasn't just the product, it was the mechanics of how they sold it. They created intense exclusivity.
Also,
They didn't just dump the Mythogen kit into every sporting goods store in America. They partnered exclusively with a specialized, high-end outdoor retailer called Evo. And to build hype, they hosted highly immersive, physical pop-up experiences.
like real-world events.
Yeah. They threw a massive launch party in Salt Lake City, and they built an interactive event right on the snow at the Brighton Ski Resort in Utah. They put the high-end product directly into the hands of the core demographic actual skiers on an actual mountain, rather than hoping they stumble across it in a suburban strip mall.
It's authentic. It's not a generic digital banner ad. It's a physical party at the ski lift. It gives the brand immediate street credibility, or I guess mountain credibility.
Little credibility, yeah.
Okay, so Mountain Hardware is surging by playing the premium exclusive game, but there's another major competitor in the broader market that is arguably floundering. And their struggle created one of the most brutally honest, juicy moments of the entire earnings call.
Oh, I know exactly what you're talking about.
We have to talk about the Eddie Bauer carcass.
Carcass is a stark way to phrase it, but it perfectly captures the predatory tone of this specific Q&A segment. During the call, an analyst named Lauren Veselescu brought up some breaking news in the retail space.
Right.
Legacy competitor Eddie Bauer was reportedly facing severe financial distress and the potential closure of 200 North American retail stores. She asked CEO Tim Boyle directly how this massive competitor liquidation might impact Columbia's strategy.
And Tim Boyle's response was surprisingly blunt for a highly scripted earnings call. He noted a bit of historical irony that Columbia actually used to act as a supplier for Eddie Bauer decades ago.
Oh, wow.
Yeah. But then he essentially diagnosed their corporate downfall right there on the open mic. He said Eddie Bauer failed because they relied entirely on their historical heritage and fundamentally failed to invest in marketing and demand creation. They thought just being Eddie Bauer was enough in 2025.
That's harsh, but probably true.
And then Boyle explicitly stated that in the grand retail hierarchy, Eddie Bauer is priced a notch below Columbia. He confidently told analysts that as those 200 Eddie Bauer stores board up their windows, he fully expects Columbia stores to step in and absorb that orphaned customer base.
It is a highly predatory Darwinian view of retail, but it's a necessary one for a CEO to take. When a weakened competitor bleeds out in the shopping mall, the surviving brand circle to pick up the abandoned market share.
But let's push back on Tim Boyle's logic here for a second. Let's expand on this idea of retail being a brutal game of musical chairs.
Okay.
Eddie Bauer just lost its chair. The music stopped. They are out. But remember what we walked through 10 minutes ago. Columbia is aggressively raising their own prices by 8 or 9% to fight off the geopolitical tariffs.
Right.
So if Eddie Bauer was already positioned a notch below Columbia in price, and Columbia is currently moving their own share even higher up into the VIP section of the price ladder, aren't they leaving that entire lower middle price tier completely empty?
That is the danger.
By raising prices, aren't they practically handing a silver platter to a new, cheaper competitor to swoop in and steal those budget-conscious Eddie Bauer shoppers rather than capturing them themselves?
You've hit on the exact tightrope Columbia is walking, and it exposes the massive risk in their strategy. By consciously vacating that lower middle price tier to protect their profit margins against tariffs, they absolutely risk alienating the value-conscious consumer who used to rely on Eddie Bauer for affordable gear.
So how do they plan to actually get them?
Management's gamble is entirely psychological. They are relying on the concept of aspirational trade-up. They are betting that the massive Gen Z marketing engine, the Bear Scat beer, the Flat Earther bets, the cultural buzz, will make the Columbia brand so desirable that the displaced Eddie Bauer shopper will convince themselves to stretch their budget.
I see.
They're hoping a consumer says, I historically only spent $120 on an Eddie Bauer jacket, but Columbia feels so relevant right now, I'll stretch my credit card and spend $150.
It is a massive gamble on consumer psychology. Because if the macroeconomic environment tightens, if inflation spikes again or unemployment ticks up, that value consumer might not stretch to $150.
Definitely, yeah.
They might just abandon the mall entirely and go to a big box discount store or buy a generic jacket on Amazon.
Exactly. The assumption that market share will naturally and easily flow upward to a higher price point is optimistic. It requires the accelerated growth marketing engine to fire on all cylinders flawlessly. If the marketing fails to justify the new price tag, that market share is gone.
So we have thoroughly analyzed the mechanics of their wild marketing stunts, the existential $100 million threat of the tariffs, and the brutal reality of how they view their dying competition. Which brings us to the final piece of the corporate puzzle, the forward-looking guidance.
Let's hear the predictions.
What exactly is management promising Wall Street they can achieve in the face of all these headwinds in 2026?
Well, the 2026 financial guidance they laid out is essentially a tale of two drastically different halves. They're explicitly bracing investors for a very tough start. They expect a 2.5% to 4% sales drop in Q1, primarily due to that tariff timing mismatch we discussed where costs are high but prices haven't caught up.
Right, the Q1 squeeze.
Exactly. However, they project a strong, robust recovery in the back half of the year, leading to a full-year net sales growth projection of 1% to 3%. And despite all the supply chain pressures and marketing expenses, they are targeting a highly respectable operating margin of 6.2% to 6.9%.
Okay, I have to ask about the math here. How on earth do you project maintaining nearly a 7% operating margin when you have a $100 million tariff anvil dropping on your head and a U.S. wholesale market shrinking by the high teens?
It sounds impossible, right?
It does. Well, you mentioned something earlier that I want to circle back to because I think it is the most brilliant counterintuitive financial maneuver in this entire transcript. The inventory starvation tactic.
Yes. This tactic is a masterclass in the mechanics of supply and demand, and it shows the leverage a strong balance sheet provides. As we discussed earlier, Columbia deliberately curtailed their fall 2025 inventory purchases from their factories because they were terrified of the incoming tariffs.
Right.
They intentionally, purposefully bought less physical product than their forecasting models said they could sell.
Which, to a layperson, sounds like corporate malpractice. Why would a company intentionally ensure they do not have enough product to sell to people who actively want to buy it?
Because for a CFO measuring gross margins, the alternative scenario is infinitely worse. Let's walk through the math of over-inventory. If you overbuy from your factories and consumer demand suddenly softens, maybe because of a recession, or maybe just because it's a warm winter, you are suddenly stuck with millions of dollars in physical inventory.
Which is expensive to hold.
Right. You have to liquidate that inventory by putting it on clearance. Selling a jacket at a 40% discount absolutely destroys your gross profit margin, it trains the consumer to wait for sales, and it cheapens the perceived value of the brand. By artificially starving the inventory pool, Columbia mathematically ensured that consumer demand would exceed product supply.
And what was the actual result of this artificial scarcity?
The CFO stated on the call that they saw the highest, most efficient conversion rates in several seasons. Furthermore, the retail inventory in the broader marketplace is incredibly clean, which is retail jargon, meaning no department store is sitting on racks of old, dusty, unsold coats.
Ah, I love that phrase. Clean inventory.
It's a great position to be in. And crucially, their cancellation rates from their retail partners were incredibly low because the retailers actually needed every single jacket they could get their hands on.
By starving the market, they created genuine scarcity. Suddenly, a basic Columbia fleece isn't just a commodity you can buy whenever you feel like it. It becomes a scarce resource. It's something you better buy at full price right now because they might run out of your size next week. It flawlessly protects their pricing power and their profit margins.
It is highly effective. But it requires incredible discipline not to chase the short-term revenue of just pumping more product into the market.
But even with brilliant calculated tactics like intentional inventory starvation and viral marketing stunts and aggressive tariff resourcing, there is one dominant force that CEO Tim Boyle kept bringing up repeatedly on the call, the ultimate, completely uncontrollable variable that can destroy all of their spreadsheets: the weather.
Yes, the phrase Mother Nature looms incredibly large over this entire transcript. Boyle explicitly noted that unseasonably warm weather patterns completely crushed their Q4 demand in both Europe and China.
It's hard to sell coats in the sun.
If it is 65 degrees in December in Berlin or Shanghai, no consumer is buying a heavy $200 thermal parka, no matter how cool the TikTok marketing is. The fundamental utility of the product vanishes. Conversely, a sudden, unpredictable cold snap in the United States can clear out store shelves in a matter of days, completely independent of whatever marketing campaign is running.
And this reality leads me to a massive structural question about the very nature of a company like Columbia being publicly traded. Wall Street demands predictable, quarter-over-quarter, linear, smooth growth.
Yes, they do.
Investors want to see a revenue chart that goes up and to the right without any jagged edges. But Columbia sells a physical product whose demand is dictated entirely by the chaotic, unpredictable whims of nature. Is the public market fundamentally mismatched for a seasonal apparel company?
That is a great question.
Should Columbia be pivoting dramatically harder into year-round, non-weather-dependent gear? They mentioned a slight push into this on the call with their new Rock Pant and Rock Light summer shorts programs. Should they abandon their identity as a winter powerhouse just to satisfy shareholders who can't handle the volatility of the seasons?
You are outlining the existential dilemma for every heritage seasonal brand. Do you dilute your core historical identity as a winter outerwear powerhouse to chase lower margin summer revenue, just to appease a Wall Street analyst?
It's a tough call.
The Rock Pant program is exactly that. It's an operational attempt to smooth out the jagged revenue curve so the company isn't so terrifyingly dependent on November and December snowfall. But the financial reality is that heavy winter gear drives the highest average order value and the thickest profit margins.
Right, because pants are cheaper than parkas.
A $300 parka will always be more profitable than a $40 pair of hiking shorts. But it poses a fascinating question for the listener. If we challenge you to look at your own investment portfolio, or even just the brands you loyally buy from, how much of a company's success is actually due to management genius? And how much is just getting incredibly lucky with the macro environment?
Wow, yeah.
When a winter sports company beats its Q4 earnings estimates, are we praising the CEO's strategy, or should we actually be praising the sudden shift of the polar jet stream?
It's a wild thought. You can have a pristine fortress balance sheet with $800 million in cash. You can brew the most viral bear scat beer on the entire internet. You can outmaneuver international tariffs with surgical supply chain precision and artificial inventory scarcity. But at the end of the day, if it doesn't snow in December, absolutely none of it matters.
That is the terrifying, fragile reality of the outdoor apparel industry. You're ultimately beholden to the sky.
Let's bring this all together for the grand synthesis, because we have covered a massive amount of ground today. Yeah. Columbia Sportswear is a company relying on a fortress of nearly $800 million in pure cash liquidity to weather an incredibly volatile economic storm.
Yes.
They are deploying wild, irreverent, heavily Gen Z targeted marketing stunts like betting against flat earthers to make their legacy brand culturally undeniable. And they are using that newly generated brand heat as a psychological shield against the dual threats of unmitigated $100 million supply chain tariffs and unpredictable, unseasonably warm winters.
That's the playbook.
They are actively starving the U.S. wholesale market of inventory on purpose to protect their margins, and they are playing a delicate, high-stakes game of price-hiking chicken with the middle-class consumer, all while hoping they can naturally absorb the value-conscious customers left behind by dying heritage competitors like Eddie Bauer.
It is a phenomenal high-wire balancing act of corporate strategy. And analyzing it leaves us with a final provocative thought to mull over as we close.
Let's hear it.
If weather is truly the single biggest driver of Columbia's revenue, as Tim Boyle openly admitted, and if global climate patterns are becoming permanently disrupted, increasingly chaotic, and less predictable, will future outdoor apparel companies need to fundamentally evolve what they are at a corporate level?
What do you mean?
Will they need to stop operating like traditional fashion and apparel brands and start operating more like agricultural commodity traders or highly advanced meteorology firms? Will the successful apparel CEO of the next decade rely less on the intuition of fashion designers and far more on predictive climate modeling and meteorological supercomputers to dictate where and when they deploy their global supply chains?
When that slow-moving luxury cruise ship we talked about at the beginning is suddenly forced to navigate waters that literally change temperature, depth, and current every single day, maybe you don't need a traditional corporate captain anymore. Maybe what you really need is a meteorologist. Thank you for joining us on this deep dive. Keep questioning the headlines, keep digging into the mechanics of those balance sheets, and keep unpacking the world around you.